Welcome to DebtCircle Key Roundups. I am Vijendra.
And I am Leela.
Today we have some important updates from the world of debt markets. Indian government bonds could see a sharp sell-off as oil prices and US Treasury yields break above key levels. SEBI has relaxed borrowing norms for invites crossing the 49% leverage limit, and NABARD has withdrawn its bond reissue plan amid rising yields and weak investor demand. So stay with us as we unpack what all of this means for investors, borrowers, and India's broader fixed income market.
Absolutely, Vijendra. The bond market is clearly under pressure right now. The benchmark 6.48% 2035 government bond closed at 7.0644% yield on Friday, and markets expect yields to move between 7.05 and 7.10% today. That means bond prices are likely to fall further because of the inverse relationship between prices and yields.
And the pressure is coming from multiple global triggers at once. Brent crude oil has crossed $110 per barrel, while US Treasury yields have surged to their highest levels in over a year. That combination is increasing inflation concerns, weakening the rupee to record lows, and intensifying expectations of future interest rate hikes in India.
Exactly, and that broader stress is also visible in India's currency market. The rupee touched a record low of 96.17 against the US dollar as higher crude prices and rising US yields pushed investors away from emerging markets. The Reserve Bank of India is managing volatility, but elevated oil prices and geopolitical tensions near the Strait of Hormuz continue to create uncertainty around inflation, fiscal stability, and the current account deficit.
Let's move to the regulatory side now because SEBI has introduced a major change for infrastructure investment trusts. Invites can now borrow beyond the 49% leverage cap, specifically for capital expenditure and major maintenance requirements, with the rule effective from April 17, 2026.
That's a significant move for the infrastructure sector because it allows InvITs to fund large repairs, upgrades, and expansion projects without being restricted by earlier borrowing limits. At the same time, refinancing is permitted only on the principal amount of existing debt, excluding interest and penalties, which helps maintain financial discipline while still improving funding flexibility.
Another major development is NABARD withdrawing its planned reissue of 7.44% bonds maturing in July 2029. The institution received bids of only around Rs 3,030 crores against a target of Rs 7,000 crores because investors demanded yields close to 7.79%.
That tells us investors are becoming increasingly cautious even toward AAA issuers. Rising volatility, tighter liquidity, and uncertainty around future rates are pushing investors toward shorter tenor and floating rate bonds instead of fixed rate long-term issuances. Interestingly, NABFID still managed to raise Rs 4,000 crores through 10-year bonds at a cutoff yield of 7.74%, showing there is selective appetite under the right conditions.
Let's now look at the energy sector, where Indian Oil Corporation has secured AAA domestic ratings from ICRA, CRISIL, and CARE, with stable outlooks, while internationally S&P Global rated it BBB, Moody's rated it Baa3, and Fitch assigned BBB- ratings valid through May 2026.
Those ratings are critical because they help Indian Oil borrow at lower costs while supporting massive investments into refinery upgrades, pipelines, and energy diversification. Compared with Bharat Petroleum and Hindustan Petroleum, Indian Oil remains well aligned with sector standards, while Reliance Industries still enjoys slightly stronger international ratings because of its diversification and larger financial scale.
Moving into the non-banking finance space, Satin Credit Care Network plans to raise Rs 84.46 crores through 8,446 unsecured subordinated non-convertible debentures carrying a coupon rate of 12.80% annually and maturing in May 2033.
The fundraising will support microfinance expansion and working capital requirements, but investors should remember these are unsecured subordinated instruments, meaning repayment priority is lower compared with secured debt. Listing on BSE Limited should improve liquidity, and market participants will closely watch asset growth, profitability, and future rating actions affecting the risk profile of these debentures.
Bajaj Housing Finance has also raised Rs 500 crores through a 3-year AAA rated bond issue carrying a 7.83% coupon. The issue closed on May 15th and was valued at nearly $52.1 million based on current exchange rates.
That reflects strong investor confidence in high-quality non-bank lenders. AAA ratings from CRISIL continue to attract conservative investors looking for stable medium-term returns despite ongoing market volatility and tightening credit conditions.
Let's now shift to the corporate sector, where Mukha Proteins reported a consolidated net profit of Rs 20 crore and 62 lakhs on revenue of Rs 381 crores, for the March quarter. At the same time, the board approved raising up to Rs 75 crores through non-convertible debentures.
That fundraising should strengthen cash flow and support growth without diluting equity, while Craftsman Automation is planning an even larger capital raise of up to Rs 2,000 crores to reduce consolidated debt of Rs 5,500 crores, lower finance costs, and improve its debt-to-equity ratio. Investors will closely monitor the extraordinary general meeting scheduled for June 13, 2026, along with details around pricing and dilution risk.
In the automotive component sector, Uno Minda delivered strong quarterly performance with net profit rising 22.4% year-on-year to Rs 325.8 crores and revenue increasing 17.8% to Rs 5,336.4 crores.
And despite a slight dip in EBITDA margins to 11.3%, the company remains focused on growth. Shareholders will vote on raising up to Rs 2,500 crores through bonds and equity to fund expansion, especially in electric vehicle powertrain capacity, while the company has also declared a total dividend of Rs 2.65 per share for fiscal year 2026.
We're also seeing continued activity in debt markets from high-quality issuers. Sundaram Finance plans to reissue AAA-rated bonds maturing in February 2028 with a coupon of 7.24%, while Bajaj Housing Finance is issuing 3-year AAA-rated bonds at 7.83%.
Those parallel issuances clearly show healthy appetite for secure medium-term debt investments. Investors are favoring established financial institutions with strong ratings and predictable cash flows as uncertainty in global markets continues to rise.
One of the biggest stories today is RBL Bank securing final approvals for Emirates NBD's strategic investment worth nearly $3 billion, or roughly Rs 26,850 crores. Emirates NBD could eventually hold between 51 and 74% stake, making it the promoter of the bank.
This is a landmark transaction for India's banking sector. The integration of Emirates NBD's Indian branches into RBL Bank will significantly strengthen cross-border banking capabilities and expand RBL's reach across important markets such as Mumbai and Chennai under the Reserve Bank of India's regulatory framework.
Global bond markets are also adding pressure on investors because the 30-year US Treasury yield has crossed 5%, while the 10-year yield moved above 4.5%. Portfolio managers are responding with barbell strategies by holding cash, gold, and commodities as inflation hedges while also staying invested in mega-cap technology stocks.
And back home, Muthoot FinCorp has approved plans for a fresh equity IPO worth up to Rs 4,000 crores, along with debt fundraising of Rs 8,000 crores through non-convertible debentures, perpetual debt, subordinated debt, and commercial papers capped at Rs 30,000 crores. Meanwhile, ICRA reaffirmed IDFC First Bank's AA+ stable rating despite operational challenges, helping maintain confidence in its funding profile.
Finally, several important structural developments continue to shape India's credit markets. Power Finance Corporation is moving ahead with its proposed merger with RSA Limited. Lumax Auto Technologies has nearly doubled its bank facilities while maintaining strong ratings, and IIFL Finance continues to face close RBI scrutiny after penalties linked to gold loan operations, even as rating agencies reaffirmed AA+ stable ratings on its non-convertible debentures. Altogether, these developments show that India's debt markets remain highly active, but rising yields, inflation concerns, global volatility, and regulatory oversight are making capital access and risk management more important than ever before.